Chapter 1, the corporation. What I'd like to talk about in this chapter is the basics of how corporations are created. The basics of decision making, at least the foundation, so that we can get started with the rest. So let's start with the course. First of all, we want to address two basic issues in this course. What long-term investments should the firm choose? We're going to develop a model to help us establish that value. But we want to look at, how do you determine the value of an individual asset, and how do managers choose those assets? The second major component of this course is to understand how firms raise funds for selected investments. So we're going to look at some factors to determine exactly how managers make those decisions. How do they gain access? And in the end, we want to understand how the company performs. How do you use metrics to assess these choices of what assets the company has purchased and how they're using them? And then ultimately, as a component of that, how do we analyze the questions and the choices that management makes in gathering money from outside the corporation? There are several major issues in the finance world. Number one, what is the risk-return trade-off? Are all risks the same? What we'll find is that even if all risks are the same, people analyze risk differently. So there is a difference in how returns are created or how they're established, which is dependent not only on the assets themselves, but also on the perception of individuals. We want to talk about how we asset the value of money in different time periods. Which is more important, profit or cash? How do taxes affect decisions? We want to discuss in at least a little bit of detail the concepts of competitive markets and how they influence the decisions that managers make. What do managers desire from a corporation? Right? Or what do owners desire from a corporation? This is often in conflict with what managers want. So what is the true financial goal of management? What should managers be doing that is ultimately the correct business strategy for the owners of the company? How are prices determined? There's a concept and a theory that we'll discuss that's called the efficient markets hypothesis. How does information work its way into prices? Do managers think and make decisions, especially in accord with the way owners want them to? So if we understand how managers think and make decisions, and we know what owners want, we can make some inferences about how the business is run, what the value of the business, and of course, we want to affect or influence the conflict that there is between managers and owners. What is cash flow? Why is that important? Are ethics important? And finally, in the end, how do we measure success? How this is done company to company, even within industries, can be different. So we want to understand how metrics are created and what they ultimately might need for company success. So next, what do we know about the business world? Most businesses are sole proprietorships. As you can see here, sole proprietorships and partnerships, both limited and general partnerships, are roughly about 82% of all businesses. The challenge we have, though, is that corporations create about 83% of the revenue. Now let's think about what a corporation is. A corporation can be those things that we hear about on TV, but they also can be small businesses that are just incorporated. So why is that important? Well, let's think about these different kinds of businesses so that we can understand why corporations tend to be such a great and large amount. A sole proprietorship is owned and run by one person. Typically, they have very few, if any, employees. Most of the employees are going to be relatives, most likely. It's very easy to create, but there's some challenges with sole proprietorships. And these are all risk-oriented things. There's no separation between the firm and the owner. So however the owner acts has a direct impact on the value of the firm and its ultimate survival. There's something referred to as unlimited liability. Because there's no separation between the firm and owner, that means that when the company gets sued, if the company loses that lawsuit, all the assets of the owner, including the company assets, are at risk. And that's really the definition and the thought we need to think about. What is at risk when you own a company? If you're a sole proprietorship, your personal assets and your business assets are viewed as one. So if you must pay a penalty, that penalty is paid through the business assets. In this case, they could also include your personal assets. What is a partnership then? A partnership is really very similar to a sole proprietorship, but there could be many more partners. All partners are personally liable for all of the firm's debts. And again, there is no separation between the partnership assets and the individual's assets. So I guess the worst person to be is the richest partner, because that's the first person that's going to be sued should the partnership itself get sued. Now, this is a definition of what's referred to as a general partnership. A limited partnership has two types of owners. A general partner that I just described earlier, typically they run the company on a day-to-day basis, right? They have the same rights and liabilities as partners in this regular kind of a partnership. Limited partners, though, have limited liability. They cannot lose any more than they invest, but for that to be true, they also have to have no management authority. Essentially, a limited partner is what we refer to in the layman's world as a silent partner. All they do is provide funds. There are things referred to as limited liability companies. All the owners of this company have limited liability, and they all can run the business. So this is a relatively new kind of a form. So essentially, it is a limited partnership where there are no general partners. Everybody has limited liability. So that brings us to a corporation. It's a legal entity that's separate from its owners. It has almost all the legal powers of individuals. It can enter contracts, own assets, borrow money. About the only thing it can't do is vote. The corporation is solely responsible for all of its obligations. Its owners are not liable for any of those obligations. So the owners of a corporation have what's referred to as limited liability. Corporations have to be legally formed. They create something called a charter. And this charter essentially are the bylaws of the organization. It outlines the strategies, the plans, the funding of the company. It basically takes into account the rules of the game, if you will. Ownership itself is represented by shares, and I'm sure we're all aware of that. The sum of all ownership value, in quotes, is called equity. That's ownership. Now, the market value of the company is the product of the market price and the number of outstanding shares. So these numbers could be different depending on how much the shares cost when the company was created and ultimately what the value of the stock is over time. There's no limit to how many shares a person can own, right? And the amount of funds a company can raise by selling its stock. So you can own as many shares as you want, but the company can also raise capital by selling stock. The owner is entitled to dividend payments. Essentially, they're entitled to the profits, right? You're the owner. You have purchased a share in this corporation that creates profits, net income. Divide net income by how many shares there are, and that's how much profit belongs to the shareholders. We see this on the news referred to as earnings per share. That's your money if you're an owner. The challenge that owners have is they can't determine, or they have no say in how they receive those profits. The company could pay dividends, or the company could reinvest those dividends into expansion, into buying other assets, replacing those assets. So that is a brief introduction of the corporation and how businesses come together. In the second part of this lecture, we'll move a little bit deeper and talk about some ways that managers think and how we would hope they would make decisions.